and welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. Today we're going to talk about money velocity. That's the V in the monetarist equation of exchange, MV equals PQ. And I will say going in that the discussion of money velocity gets some people animated, as I guess a lot of economic topics these days do, because they're more significant the more volatility we get in the economy. You know, these discussions have more importance to them, more salience. And so I will say in advance that some people are going to disagree with parts of what I say over the next 15, 20 minutes, whatever it is. And pretty much everything that I say will find somebody who disagrees with what I say. Again, that's sort of economics. I mean, we have widespread disagreements about a lot of things, but I do find that people seem to dislike monetarists for reasons that I don't really fully understand. It may be that it just seems too simple to be really useful. And if you've gone to school for many years for economics and gotten an expensive PhD, maybe you feel like you should be using a lot more math than monetarists typically do use. I don't really know, but certainly monetarism has been in favor at times and out of favor at times, and right now it is considerably out of favor, although it seems to be making a little bit of a comeback. But velocity is a key element of monetarism. If you can measure the amount of money, which maybe there's some question about that, but if we can measure the amount of money in a reasonable way, but we don't have any idea what causes changes in velocity, then the model is a lot less useful. And if I was going to critique monetarism, if I was going to attack it, then that's where I would attack it. So monetarism, again, basically boils down to MV equals PQ. And so the way to think about that equation, and the reason it makes so much sense, the reason it's an identity, in fact, is that it basically says that the amount of dollars spent in a year to buy things, M being the amount of money and V being the velocity of money, of how many times a dollar is spent. And so that side of the equation is sort of the total number of dollars spent. That has to equal the total amount of stuff produced and sold. And that's the Q, which is the real output, times the price level of that output. And so PQ is the nominal GDP, the total amount of output. And so it sort of makes sense that those two things sort of have to be equal. The amount of money you spend on stuff should be the amount of stuff that got sold. And so if you're going to attack that model, we measure money. We at least have some idea of how to measure money. There's different monetary aggregates, and we can debate about how well we measure them, but we at least notionally understand what it means to count money. And we understand notionally what it means to have a price level, an average price, and the idea of real output, that's probably in a lot more dispute. People don't necessarily agree that GDP is correctly counted, but you can't really attack. If you're going to attack monetarism, you can't attack the GDP side, because that shows up in Keynesianism as well. So, there are there's plenty of room to critique GDP, and I know people who do, and I think there are very plausible arguments to be made that we don't measure real output correctly. But if you're going to attack monetarism, that's not where you would focus. Where you would focus is on velocity. How do you measure how many times a dollar gets spent? And that's effectively what monetary velocity is. But this model is no more complicated. It's no more no easier to challenge than it is to challenge any element of the new Keynesian model, which is ridiculously complex. And there's lots and lots and lots of assumptions that you can attack. At least with the monetarist model, you can attack there are only a few things to really attack aggressively. And the main one, of course, is velocity. So what do we know about velocity? Well, first of all, I always have to say, people who don't know a lot about monetarism and yet attack it typically say that Friedman claimed that velocity was static. It clearly isn't. Therefore, Friedman was wrong. Therefore, monetarism was wrong. But Friedman never said anything that suggested that velocity was static. And it's not necessary to monetarism that it be static. For it to be a useful model, it is sort of necessary that we have some idea of what drives money velocity. And again, people who don't know much about monetarism will say that it's sort of a random number. We don't really know what causes the movements in it, and so therefore the model is useless. But we do have some good ideas of what causes changes in monetary velocity. Now, Friedman did say, and this is sort of our first clue, that velocity is the inverse of the demand for real cash balances. So in monetarism, the amount of money out there is obviously very important, and we think about this in terms of cash balances, especially if you look at M2, which is sort of the one that I tend to focus on most. But at any given time, the level of balances is fixed. Okay, if you spend money from your account and you go buy groceries, then you put it in the account of the grocer. If you spend money to buy a stock, then the seller of the stock gets the money and it goes into their account. If you buy a government bond, then at issue, then it goes to the government, who has already spent it. That's why they have a deficit. And when the government spends it, it goes into someone else's account. And so you can move around these different balances, but we can't really affect from the consumer side, we can't really affect the level of balances, right? So the main thing that moves there is the main thing that we can control as consumers, I guess, is how fast we spend the money. You can't actually lower the amount of balances in the system very easily. Now, obviously, the Federal Reserve and banks with their operations do over time change the level of the money supply and therefore the amount of balances in the system, and those do respond to certain other influences, but those tend to be less important in sort of the medium and longer term in terms of the effect on money velocity. The big changes in velocity come from changes in spending behavior and in the demand for real cash balances, as Friedman said. So what makes me want to hold more cash, which implies a lower money velocity? If I have a larger balance in cash, that means I'm spending it less frequently. Or conversely, what makes me want to keep a really low cash balance? Okay, so that, which implies a very high money velocity. And so think about this as money being a hot potato. Okay, think about, you've got a checking account, and when cash comes in, are you really trying to manage so that you don't have much cash in that account at all? That you're either spending it or you're investing it, or do you not really care and you don't mind having a bit of a larger balance in your checking account? What drives that decision? And it turns out that one of the large influences on that decision is the level of interest rates. If interest rates are extremely low, and I'm talking longer term interest rates here, but if the 5-year interest rate is at 14% and you're earning nothing on your checking account, then you have a very large incentive to not hold anything in your checking account and to put your money in a 5-year CD. If, contrariwise, the 5-year CD rate is 0.5%, then why not hold cash? there's really not much of a difference there. And so you can sort of see that the level of interest rates, and in particular longer-term interest rates, can influence the level of money velocity by changing the incentive to hold cash balances. So the higher that interest rates go, the lower cash balances go, and therefore the higher money velocity goes. So there's a positive correlation between the level of, say, 10-year interest rates and the level of money velocity. And this has been true for a very, 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 very long time. Now, that actually leads to an interesting conundrum, an interesting puzzle. It's called the price puzzle in economics. And that is that when the Fed first starts to raise interest rates, when they first start to tighten in any given cycle, you tend to see an acceleration in inflation initially. And it's really sort of puzzling. You would think that the Fed tightens and immediately inflation goes down, but it doesn't. It goes up. And the reason it goes up is that the first thing that happens when interest rates goes up is that everyone lowers their cash balances because they go out and they buy the bonds, right? And when they do that, they're increasing money velocity, which increases PQ, and that ends up increasing the price level. So that's a short-term effect, and it fades away, but that's a direct response to the rise in interest rates. Now, if you're earning interest, some cash balances earn interest, and so it's more complex now than it was, say, in the mid-'80s when cash always earned zero. In that, if your cash balance is earning interest, and the Fed tightens, and so they raise short-term interest rates, but long-term interest rates don't go up, then you actually could have a Fed tightening leading to lower velocity. That takes a fairly specific set of circumstances. You've got to have a lot of people who have interest-bearing cash balances. Those interest rates have to go up more than longer-term interest rates, and other asset classes need to not be affected by the rise in interest rates. So it would be a fairly unusual thing to have the Fed start to tighten and have money velocity go down. But I want to concede that there are certainly circumstances that you can imagine where you can get some weird outcomes here. But typically when we model velocity, we model it as a function first of interest rates. Now, that's not the only effect on monetary velocity. Another one, which is sort of co-integrated, if you will, with interest rates, is the level of inflation expectations. So all else being equal, if interest rates don't change, but you start to expect more inflation, then that zero interest rate cash balance you have has a much worse real interest rate associated with it. It's less poison, or it's more poison when inflation is going up. You're losing more of that purchasing power. And we actually have seen this in our business recently, and we have a strategy that we're busy in the process of rolling out that is attempting to return monthly CPI instead of giving you zero on cash. The goal is to give you monthly inflation, and that sort of strategy had very little importance, was not all that appealing 2 years ago when the short-term interest rate was zero, but inflation was around 1.5. Now that inflation is around 5.5 or 6, then all of a sudden people really hate their cash a lot more. And so you can sort of see that as inflation expectations rise, you don't want to hold inert cash if you can get anything which has some sort of return to it. And by the way, this is, I think, one of the reasons that right now, even though we're seeing higher inflation, which normally is very bad for stocks, you're seeing equities do well. And part of the reason is that I think a lot of this cash is coming off of the sidelines and out of deposits and going into stocks, going into commodities, going into anything that promises, at least a chance of beating inflation. And of course that always happens at the wrong time, but I think that's one of the reasons that we're seeing stocks go up. But anyway, inflation expectations are an important input here to money velocity. Now you can sort of see that there is an ugly feedback loop here, that if you expect more inflation, then you get lower cash balances and higher velocity. And as you get higher velocity, you get more inflation, which presumably will lead you to expect more inflation and then could lead to even higher velocity. So with a lot of what happens in the inflation world, in the inflation dynamic, a lot of the things we look at have these recursive, these ugly feedback loops where you have virtuous cycles that lead to, lead positive things to lead to more positive things. Lower inflation leads to lower interest rates. Lower interest rates leads to lower money velocity. Lower money velocity leads to lower inflation, and so on. But also vicious cycles where higher money velocity leads to higher inflation, which leads to higher interest rates, which leads to higher money velocity, or the dynamic I just mentioned where higher inflation expectations lead you to higher velocity, which I guess is part of that same cycle. And that's the reason that inflation trends have persistence. And the reason that inflation has long tails is that you get these recursive effects building on themselves. So inflation expectations is another driver of velocity. So again, that's sort of part of interest rates. But if you can imagine a circumstance where interest rates don't move, which has sort of been the recent case, actually, that we've had a small movement in interest rates and a fairly large movement in inflation expectations, you can see that can lead to, by itself, can lead to an increase in monetary velocity. Something which is a little more difficult to measure is the demand for precautionary cash balances. When I model this, I use something like economic volatility, and there's various ways to measure that. Market volatility might be one proxy, but the idea is that when people are scared, all else equal, if you are scared, you tend to hold more cash. If you're not sure what the future holds, you keep a rainy day fund. And if you're very, very confident about what's happening out there, if things are good, if we're in the salad days of a global expansion, then you tend to hold less cash. And so precautionary demand for cash balances leads to lower money velocity. And that's part of what we had in this most recent crisis is people were holding more cash than they would otherwise have held because of COVID. They didn't know what was going to happen. And so, all else equal, you would hold more cash. Now, those three things are the way I have modeled velocity for a long time, and it's a pretty successful model. Recently, I've been talking to some people about a fourth thing, which I guess I believe is plausible, and that's that there's the demographic profile of cash balances could affect velocity. And what I mean by that is if cash balances are mostly held by the wealthy in general have a lower propensity to consume and so might tend to sit on cash balances that are larger than they otherwise would. Whereas people at the lower income part of the spectrum don't tend to have very many cash balances. If it comes into their checking account, it gets spent right away. And so ordinarily that wouldn't be a big effect because the demographic profile of cash balances shouldn't change a whole lot over time, over short periods of time. In the most recent crisis, it was actually quite substantial how much that changed because because everybody got a large check, and that check was relatively larger if you were at the low end of the income spectrum. It was a much larger check relative to your income than it was for the wealthy, so it didn't change wealthy savings all that much, but it changed the the savings for the less wealthy by quite a bit more. And so it did change the demographic structure of those balances. And that's one reason, along with the increased precautionary demand for these cash balances, that velocity plunged in this most recent crisis. Now, as that money eventually gets spent, so if you think about those cash balances, how will the prior demographic structure of cash balances, will it get restored? And the answer there, I think, is it almost certainly will over time. Either the low-income people will end up spending a lot of that money because they have to, or they won't, which means that they'll be higher up in the demographic stack. And so at the end of the day, the people who are wealthiest have the most cash, and conversely, those who have the most cash are also wealthiest. And so to some extent, I think that giving large amounts of money to the poor in a crisis can depress monetary velocity a lot and lead to more spending, but it doesn't stay that way permanently. And so where we are now is we're at very low levels of monetary velocity for all of these reasons. We've got low interest rates, although they're headed higher. Until recently, we had low inflation expectation. They're headed higher. In COVID, through much of COVID and even coming out of COVID, we have a greater than usual demand for precautionary cash balances, which tends to depress velocity. And a lot of the government largesse has gone to the low end of the income spectrum, which tends to, which I speculate will tend to decrease monetary velocity. And I'm putting more caution on that last statement because I haven't done the depth of research necessary for me to be very confident that that's the case, but it's plausible to me. But all of these effects have been pushing down monetary velocity, so it's the lowest it's been in history. But these things are changing, and this is the scary part looking forward for inflation, is that going forward, we are starting to see higher interest rates, and to the extent that central banks are worried about inflation, we just saw a reaction from the Bank of England and the Bank of Canada today that suggests that they're more apt to be raising interest rates in the future. The Federal Reserve is supposed to start tapering its quantitative easing fairly soon, and sometime next year may raise interest rates. Growth is currently quite strong, and markets are strong, which tends to lower the demand, the precautionary demand for cash balances. And the demographic profile of these cash balances is going to gradually go back to what it once was. And so the collapse we saw, so in the crisis, we saw this massive increase in money and the collapse in monetary velocity. And we kind of expected a lot of that collapse in money velocity. But one of the things that I said a lot, and I think I continue to believe very strongly, is that we cannot sustain that level of monetary velocity. It is very hard to have money moving as slowly through the system as it did for the last 12 months, 18 months. And so that's going to go back to normal. And so unless we start to drain the actual money balances out of the system, unless we decrease the money supply, the eventual recovery in monetary velocity is going to make inflation much more persistent on the upside than I think people are ready for. So that's where I think we are going. And that's all about monetary velocity. As I said up top, there's a lot to disagree with in here. There's a lot of debate about this stuff, and you may well disagree with many of the things that I have said. I do hope you enjoyed the episode anyway, and if you do have some disagreements that you would like to express, or you have some agreement you would like to express, or you just would like to express yourself, come to enduringinvestments.com and fill out the contact form, and I'll get back to you. If you want to talk about anything related to inflation or our strategies, go fill out the contact form. You can follow me on Twitter at inflation_guy, because I am the inflation guy. And you have been listening to Sense and Sensibility, the Inflation Guy podcast. Defend your money. And when inflation comes for you, remember, you know a guy.